Bloomberg Audio Studios.
Podcasts, radio, news.
This is Masters in Business with Barry Ritholtz on Bloomberg Radio.
What can I say about this week's rock star guest, Annie Lamont? Incredible track record as a venture capitalist. She's co-founder and managing partner of Oak HCFT. I can't list all her accolades because they're just 100 most influential people in healthcare, Forbes Midas List 5 times, top 100 venture capitalists according to CBE Insights, top VCs on the New York Times list, top 20 private equity power players, Fintech Finance 40. She has had 70 exits, 70, over the past 25 years, 15 IPOs, just an incredible track record of investing primarily in the healthcare, but also the financial technology space. There's surprising amounts of overlap in terms of access, outcomes, cost, speed, friction, especially those last three, cost, speed, and friction between the two. She's also First Lady of Connecticut, married to Governor Ned Lamont. She's been doing VC work for 35, 40 years, and just is as insightful as anyone in the world about those areas, especially healthcare. I found this conversation to be absolutely fascinating. I think you will also. With no further ado, my discussion with Oak HCFT's Annie Lamont.
Thanks, Barry. Great to be here.
I've been really excited for this conversation. You do so many interesting things. But let's start with Oak Investment Partners. You were a GP there starting in '86 in HC Ventures. What led you to that part of your career?
Well, very early on, I got out of Stanford when Silicon Valley was really at the very beginning of Silicon Valley, and joined something called Hambrecht & Quist, which was a boutique investment bank venture firm, sort of legendary at that time. I think I was the 50th employee, and really fell in love with venture from day one and working with entrepreneurs. I carried Steve Jobs' bags on the Apple IPO roadshow in my first 3 months there.
Wow.
The first 3 months, we also took Genentech public. So I worked with two of the greatest entrepreneurs ever. I didn't know that at that time.
That was my next question.
Yeah.
Did you have any sense of who you were rubbing shoulders with, or it was just like fast-moving blur?
Certainly those two seemed like extraordinary people, and I extrapolated that to most entrepreneurs. I quickly learned they were two extraordinary individuals, but it just got me hooked. I thought if I could just learn and be with people like this and not be the entrepreneur, but be the person that supported, helped, edited, therapist, whatever was required, I just wanted to spend the rest of my life with people who envisioned the world as it should be.
And H&Q is known for a lot of their software, internet, hardware, technology. What led you over to the healthcare sector?
So when I joined Oak, which was really just a couple of years out of Stanford, we were founding Genzyme the year that I joined, one of the also very first biotech companies. And there was only one public software company at that point, and I wasn't really interested in one of the 300 disk drive companies that were being created.
Not an iOmega fan?
Yeah,
I remember that one.
Yeah, they had done Seagate, sort of the original Seagate Shugart. And so I said, I want to create my own space. I want to create my own expertise in an area that I could fundamentally be interested in. And that ended up being biotech. And so focused on life sciences the first 15 years of my career, and back companies like Alexion, Cephalon, Alkermes, a whole host of companies.
Were you anything healthcare or medical or biotech related at Stanford? What did you do?
No, I should have been a hum bio major,
right?
but I wasn't. I had no idea how interested I was in the topic, but I became fascinated by it and educated myself, and wished it would have been nice to have had the internet back then. But
what did you study at Stanford?
I was a political science major, so of course that prepared me for my life with my husband ultimately.
Right.
But I did have an interest in politics.
But no technology, no engineering, physics.
I mean, everybody takes a computer science course at Stanford. But
really interesting. So Oak Investment Partners, very sophisticated VC platform, going back to like the late 70s, I think is when they launched.
Yeah, exactly.
So when you joined them in the 80s, what did you focus on? What was it healthcare right out of the gate, or how did that transition take place from carrying Steve Jobs' bags on the road show to focusing on healthcare?
I think my interest, as I said, we'd founded Genzyme, just intellectually interested in the area, but worked on some software companies back then, and then decided I really needed my own hook. Like the reality is, in every career, you need to create your own expertise and your own special lane, and that was going to be my lane. I wanted to differentiate myself from all the other engineers at Oak and do my own thing.
Was that kind of a white sheet at that point? There wasn't a lot of competition there? Yeah.
Yeah, that was the other thing. There wasn't any real competition at Oak, and in terms of the market, it was a new burgeoning area, and you didn't have to be a PhD. You could hire PhDs to help you analyze these things.
What was Oak's core focus when you joined them? Was healthcare something that they had previously played in, or no. You essentially, did you stand up that sector at Oak?
Yes.
Huh. So what else were they investing in at the same time?
Well, a lot of hardware, as I said, a number of disk drive companies, PC. I mean, we did actually invest in Compaq during that period. And so it was more PC, hardware, telecom related.
So clients, the LPs who come to Oak, were they just giving them cash to be allocated across all these different sectors? Or did people say, all right, I'll try a little bit of healthcare and a little bit of hardware?
No, we always had, and we do have at Oak HCFT, one fund that everything, and we would choose the allocation.
Huh. So that investors are getting exposure to whatever you guys think has the most potential.
Right.
So you're listed as a managing partner at Oak, as well as a managing partner and co-founder at Oak HCFT. What's the relationship between the two companies?
There is no relationship. Oak Investment Partners is wound down effectively. I'm still there until the last company is exited.
Just waiting for for the last.
Exactly. I have an obligation to those LPs in that firm, but the reality is there is no relationship. We started Oak HCFT because we had two practices, obviously in healthcare and fintech. Andrew Adams and myself launched the firm 10 years ago, and really wanted to focus on sort of the new model of investing that wasn't just Jedi Knights from 25 years ago, where it was just you're a good advisor and you don't have a talent function and you're not. The model really changed to become a service entity to entrepreneurs, to support entrepreneurs. And it was always partnering with entrepreneurs in the past, but the reality is it became a far more competitive world. You really needed to be deep in a specialty to differentiate yourself, and you needed to have things like tech support. Talent support is enormous because it is all about people. We have 5 individuals that are just singly focused on talent and attracting talent for our companies, and also introducing us to repeat entrepreneurs we haven't invested in before.
So you've used the phrase Jedi Knights in the past. Tell us a little bit what you mean by that. I get the sense the world of venture today is very different than the 80s and 90s. Very
different. I think the Jedi Knights means that it's just a group of individuals. It's maybe a firm, but it's a group of individuals that are sort of all out for themselves, just investing directly with entrepreneurs, with no real overlap between anyone else in the firm and that entrepreneur. Whereas now, I would say, like Oak HCFT is very much a team-based approach, where we support the entrepreneur in a myriad of ways. Whatever they need, we will supply as a firm.
So some of the VC books and autobiographies and the like that I've read kind of imply the early 80s and earlier days of venture was first they would write a check, and after they had been writing checks for a few years, they ended up having a bit of a network of other engineers and other venture funds and other entrepreneurs, and so people would plug into that network. It sounds like you're describing something much more comprehensive and holistic than the venture of old. Servicing the entrepreneur, put some flesh on those bones. How much service does Oak provide to the companies you work with besides funding?
I think that, first of all, we should just talk about the difference between a world where
Sure.
there was less capital and more entrepreneurs, right, in the early days. So the supply-demand balance was such that there was a lot more power, I would say, with the money than with the entrepreneurs. And the great entrepreneurs even.
I
would say that's flipped in this world, in that there are obviously many more entrepreneurs, but there's also a lot more money in the industry. And so you really have to differentiate yourself. And I think that's where this service model came in, of support. That is how, in part, you differentiate yourself. And yes, it's great relationships and great advice, but it's also the wraparound of talent, which is huge, like recruiting and understanding that you're providing someone, go-to-market advice at times, exit, really understanding the process in terms of exiting companies, introductions, which is the importance of being deep in these two sectors, is the customers. We know the customers intimately. We have great relationships with them broadly. And so we can help make the introductions, as well as many of those customers end up being buyers of the companies. And so just understanding that life cycle and being completely connected to those communities is hugely important.
So that flipping of the power dynamics from the capital to the entrepreneur, does that have anything to do with companies now staying private for so much longer? That seems like there's endless amounts of money around and no shortage of people willing to fund startups. How does that dynamic play out with all these companies just postponing IPOs for seemingly much longer than they used to?
I think it's less about postponing IPOs, although certainly some of the major, some of the very large companies are doing that in order to realize full value. I would say that the IPO market is not, it is so cyclical. It's just not, for example, it's not friendly right now, and it's hard to get exits. So I would say in these two sectors, a Stripe can go public anytime it wants. It is when to choose to go public when it feels like the value's there and they're in the best position from a profitability standpoint and growth perspective. The reality is most companies cannot go public. What has changed dramatically in the last 30 years is that companies could go public much earlier in their life cycle. Now, biotech, which we don't do anymore, we do all technology-enabled software and services in healthcare, and that pivot started in 2000 with Athena Health. The reality is it is not an exit to go public, and with biotech, it's just a funding mechanism, right? It's a public-private world in biotech. The rest of the universe, you really have to be a more mature company. You have to be an over $1 billion market cap company to have it make any sense to go public. There used to be companies that have $100 and $200 million market caps that would go public, but it's been made much more difficult to be a public company. There are far fewer people that play with those companies. If you don't have a large market cap, the liquidity isn't there. The dollars are so much larger going into these public companies that it's a very different world than it was 30 years ago. But now we've created in the private markets a sort of private public world. And I would say while 80% of our exits are through strategics, the financial PE world is our buyers for early stage companies, but we have to get them profitable. Okay?
It seems odd that markets are at all-time highs, at the same time not a friendly IPO market. I'm trying to remember the last time those two things happened at the same time. Right? Like you think back, all-time highs, late 90s,
right.
Red hot IPO market.
Red hot.
Even mid-70s
right.
Before the financial crisis, pretty robust IPO market. And then again, venture and IPOs right up and through the early part of the pandemic, red hot market. This is my first example of all-time highs in stocks, but not so much in IPO issuance.
Right, but I think if you looked at the market, so much of it has been driven by the top 7 tech companies. So it's a bit of a head fake. You're now seeing rotation, right, in terms of other companies.
Q3, yeah.
Other companies now benefiting by the markets from being higher. But I think the reality is right now we just have an overhang from, certainly in my world, I can speak to healthcare and fintech, a number of companies going public and then disappointing. Or valuation just being excessive compared to the maturity of the businesses. So I think there's just a hangover from that, and people are going to invest in known entities that are already public at this point, and we still have a ways to go, I think, for some of those companies, many of those smaller to mid-sized companies being valued in the marketplace and appropriately. So,
really interesting. So let's talk a little bit about some of the companies that you guys have invested in. You were very early in some iconic names. You mentioned Athena. There's also One Medical, Village MD, Devoted Health. Quite a run of really big names. Tell us what led you to these companies. How are you so early, so often in companies that turned out to be, big movers in the space?
Well, I would say it started with Athena Health, backing Jonathan Bush and the Park brothers there, Todd and Eddie Park, who then founded Castlight, actually, by Todd, and then Devoted. So a lot of what we do are repeat entrepreneurs. Once you find a great entrepreneur, you develop a deep relationship with them, their friends, as well as business colleagues, and then you back them over and over again. And so we've done that very successfully over time. But it did start with the whole tech-enabled services approach in healthcare started with Athena. And it started with our view that we really just wanted to invest in things that lowered cost, improved outcomes, and patient experience in healthcare, period, the end.
Give me those three again. Lowered cost, improved outcomes, and patient experiences.
Yes.
Well, that sounds like, the Holy Grail, if you can do all three of those.
So you don't always do all three, but at least two of them. It really is a mission for us in trying to improve healthcare. And we started, Athena was the first cloud-based healthcare company. And we invested in them. And really, it was just a rev cycle management company then, which was part of our thinking also around why we did payments and fintech. A lot of overlap in the whole payments world in healthcare. But so, and then it became an EHR, electronic health record company, 7 years later, actually. And so now they have one of the most important EHRs in the country, in that space. But really, it was just like pay doctors faster, better using technology. And so if you're looking at some of the newer companies, think Devoted, which is a fascinating company that's focused on Medicare Advantage and is competing with all legacy companies, United, Humana, Elevance, Anthem. If you look at what Devoted is doing, they have redesigned the entire tech stack. They're using Gen AI in their function. They are a combination of a Village or Oak Street and an MA plan.
Explain that for the
Meaning that
layperson.
they have Devoted Medical Group, which started as virtual, but is a managing network of the care. Because you cannot as a health plan directly manage the cost of care. Cost of care is 85% of all health care. And so as a health plan, in order to manage care, you actually have to, in part, own the care. Mm-hmm. And so Devoted Medical Group starts with, primary care docs virtually, wraparound services virtually, as well as extending their network so that they can actually impact the quality and cost of care. So there really is nobody else effectively doing both, being the NMA plan as well as being a source of managing the care. And so they've done that amazingly well. The fact that they have a modern tech stack that no one else has. Everybody else is riding off of 30 and 40-year-old legacy programs. Even, if you look at Epic, just from the, software side, that was originally based on mumps, from the 1970s. Wow. So what's exciting about Devoted is that you're now seeing the impact of all of that, whereas MA plans all over the country are suffering, and they're actually excelling in this environment.
So let's talk a little bit about quality and cost. It seems like healthcare, unique in the U.S. business space, has been so resistant to an end-to-end form of technology that improves quality, reduces costs. Like technology and computers and software seem to have improved productivity and lowered costs everywhere 20, 30 years ago, and it's still compounding. Why has healthcare been such a challenge to build in basic technologies? Why are they still working on 30, 40-year-old legacy systems?
Well, it's a little like banking, as many of those are also working off of COBOL systems, but are now finally being reinvented. I would say healthcare. If you actually looked at most people who have worked in healthcare, there's almost like a right brain, left brain disconnect in that you're either tech focused or you're healthcare focused. And I would say what's happened in the last decade is that you have a younger generation coming into the industry that are just naturally tech focused. Like they're tech savvy users. They're a number of technologists that are now interested in healthcare. And so there's been much more reinvention. I mean, I think not to talk about devoted too much, but the reality is the CEO, Eddie Park, is a computer science major from Harvard. So that is like a different mentality. And I would say if you look at most healthcare companies, they just have not focused on that. And they haven't. If you're a hospital system, in general, you've not been forced to be truly efficient. HCA, different story. They have. But in most cases, they've implemented Epic, or in some cases on the ambulatory side, maybe in Athena. But they are not tech. This is not their business. Their core business is delivering healthcare, and they really haven't understood the power of tech. I do think what's changing and the massive inflection point right now with Gen AI, you now have all this unstructured data that is abundant in healthcare, and you now can take that and have the power of that to change workflow, to change and support the doctors and nurses that are delivering care in a way that doesn't require behavior change, but makes their lives easier. And that is going to be a game changer.
So I want to put a little, it's almost a cliche to say flesh on the bones, no pun intended. So I have My Charts by Epic on my phone, and it's the first app I've ever used where I could renew a prescription, I could set up an appointment, I can ask a doctor a question. But literally 6 months ago, if I wanted a record before I put this on this phone, the doctor's office would say, fax your request to us. Like, what's a fax? I mean, really? We're still using 50-year-old technologies, but that seems to be in most of the medical profession. I know there's some security concerns and some rules about what can and can't be emailed, but faxes, I mean, they're living in the 1970s. Is it that far behind the curve for much of the medical care that's out there?
Yes, just even in New York City, just go to any doctor and you will find that they're still faxing or handing you a piece of paper, and they're not integrated with their own hospital system that they may be affiliated with or have surgical privileges at. It's absolutely insane. My images, I'm still carting around on discs, right? It's crazy. Now, the amazing thing and the problem with HIPAA is you're right. Like, you can't do Zoom. You're not supposed to do Zoom, right?
Because it's not secure?
Because it's not, you don't have HIPAA, it's not HIPAA compliant. What makes absolutely no sense is that a fax is considered secure.
Right. It sits on the fax machine somewhere for hours
Anybody
until someone...
can see it.
Right.
The sanitation worker that night can, see it. The whole thing's crazy.
So much
and
for
yet
privacy.
Somehow, your private email is not private enough. So, yeah.
So I mentioned My Charts. Epic is still private, very large private company.
Yes.
There's been some litigation because of antitrust concerns with them. How big is their penetration if so many offices are still, faxing records around? Their
penetration is enormous and growing. And effectively, Cerner is losing traction and losing clients every day.
Really?
And yes, Epic is owning that market.
Is that because the software is so good? And I will tell you my experience with the app, a 10 out of 10. But what else is happening behind the scenes that's giving them such an advantage over everybody else?
Well, I think Cerner lost its way in management a decade ago.
Oh, really?
A decade ago.
So it just opened up the...
It just opened up. There wasn't, it takes time to create all the different modules and all the different departments. So this is just a time game almost, and that, Epic had a lot of time to create integrated software across all of these different departments. And because they got every academic medical institution in the country to effectively adopt them, they've become a standard. And there is a danger in that, right? In terms of, if you talk about monopoly, they are going to have a growing monopoly in this market. They're also, as you say, it's a benefit. Their view is like Apple. They're going to be a walled garden, and that'll be a benefit to the customer, and that's okay. And certainly hospitals, like it, and there's a real benefit to it. I do think the issue is, we would never sue Epic for any of our small companies that are trying to interface with them. That isn't the way we roll. But I do think that it's a cautionary note about the amount of power
they've become the 800-pound gorilla in the space. Is that what's happened?
No question. And you as an innovator has to have privileges to link into that system.
Right. So they were the disruptor, and now, like Apple was the disruptor, and now they become the dominant player. So that's why there's some challenges. I was kind of shocked when I saw the chatter about antitrust, because literally it's the first app that just works as a patient. Wait, I could do all these things, prescriptions, appointments, I could see x-rays or whatever. Wow, nothing else has ever worked this well. They always send you to a website, which opens up a different site. Nothing really felt secure. This really does feel like a secure app. So does that create opportunities for other companies to come in and being disruptors, or are they sort of blocking the entranceway to new startups that want to compete in that same space?
Right. Well, I think, and let's define the space, right? That is just for providers and hospital systems specifically, not independent providers. But you think about the way we think about healthcare in general, and what we do in tech-enabled software and solutions is we're treating pharma services. So pharma is a client, employers, payer-employer market is a client, and payers are clients beyond our customers of our companies, beyond just hospital systems. Actually, this has been the hardest place to play, and where we've made the least number of investments, the fewest number of investments, is in hospital systems, because Epic owned it. And so it's been a sort of dangerous territory for a young innovator to go into. But there's plenty of opportunity to have payer solutions, to focus on creating companies that are value-based, or focused on how do we create better outcomes in Medicare, Medicaid, and commercial, that don't mean that you're competing in the hospital environment. Again, but back to Gen AI, I think the reality is, because of the power of our unstructured data, I think that there will be many more opportunities to be a disruptor in the hospital market. And I don't think it's certainly possible. My dream would be in a decade, 10 to 20 years, that you wouldn't need an Epic, because you would have the ability to integrate with all these solutions and using unstructured data across the hospital.
So you guys aren't necessarily an investor in hospital systems or hospitals,
right?
But when we look in the hospital space, there's been a lot of private equity activity. There's been a lot of consolidation. A ton of not-for-profit hospitals still carrying that moniker have been picked up by for-profit private equity players. How do you look at the consolidation taking place in the hospital chain area? How does that affect how you think about software technology and integration?
There will be more consolidation. It will mostly be done by not-for-profits. That is, the vast majority of hospital systems now are part of not-for-profits, right? The private equity world, we consider ourselves venture capitalists or growth investors, not PE. But PE, has bought several hospital systems. Not all of it's gone well. I do feel there's some backlash to that. Our goal is to reduce costs in healthcare and improve the patient experience. And you can't really do that if you're focused on owning hospitals. The reality is everything we want to do is keep people out of hospitals. Like, that's the goal, right? Nobody wants to be in a hospital. Nobody wants to die in a hospital. So everything that we want to do is a better patient experience in the home, right? Ambulatory surgery or in the home outside of the hospital system. So that's our goal and focus, not owning hospital systems. I will say I was on the board of HCA for a while, not as an investor, but an observer of the best hospital system in America. And if you think about that was a PE deal. It was owned by a family, but multiple times, right? They went public, they went private, they went public again. Right. And that is the best run hospital system in America as a for-profit.
Really?
Yes.
That's
the
really
best run, the most efficient, great outcomes. And I think the way you've got to look at this not-for-profit hospital system is that every not-for-profit hospital is a for-profit hospital because every decision is made by a for-profit doctor.
Right. Somewhere along the line, someone is making a decision, and that
obviously that
the
impacts
math
their
matters.
income.
Yeah.
Right. So there's no such thing as a not-for-profit hospital in America. Truly.
So what are the better-known hospitals that HCA manages? If I'm not familiar with HCA generally.
Well, they're going to be brands, there's Baptist, they're going to be brands all over the country, and they're going to be different in every market because they want to be local,
Right.
feel local. And so you wouldn't necessarily know the brands. It's going to be Florida, and it's going to be city by city, and every hospital will have a different name.
Like, I've been fortunate to not spend a whole lot of time in hospitals. My experience at NYU Langone was kind of eye-opening. Well, first, sometimes you get advice, hey, go someplace that specializes in what you need.
Yes.
So they've seen every variant. Right. And even with that, I wasn't prepared for what an amazing factory assembly line. And I mean that in the most positive sense of it. It's like, we do 1 million of these a day. Whatever you have, it's not a problem. We've seen it. And it was true. They had it down to like, bing, bang, bing, you're in and out, and it was really impressive to see. I'm just curious if that degree of competency, I think my whole copay for the whole experience was $50, which I guess just means my wife has good health insurance as a New York teacher. But it was really impressive. Is that specifically a function of one hospital, or is that a broader management approach to the whole chain?
New York does not allow for-profit hospitals,
right?
So you wouldn't experience it in New York State.
It did not feel like it was a not-for-profit.
Yes,
it felt like everything was structured to get them in, get them out, move on to the next.
We have. New Yorkers are lucky in that they've got a somewhat competitive hospital environment and
for sure
and excellent care here, right? So no, it's not, and that is. I think if you sat in a boardroom of a not-for-profit and a for-profit hospital, you'd be amazed how similar the conversations are.
I don't doubt that. I don't doubt that at all. How do you think about having sat on a board? How do you think about managing problem hospitals? I just got off the phone with a friend in Florida who jokingly said, if you fall and break your leg in Florida, you don't call an ambulance, you call a cab, you call an Uber to take you to the airport to fly up to New York. I think he was exaggerating a little bit, but that's not the first time I've heard things like that.
I hear it over and over again. People come to, from Connecticut, and people come back to Connecticut. All that they do their health care.
Here,
Connecticut,
Northeast.
maybe their or Northeast could be their second home, and maybe they're domiciled now in Florida, but they come back for the healthcare system.
How does
here.
a system that has that sort of reputation, how do they address that? It seems like
in Florida,
you would think that they have lots of people who are older.
They do.
They should be really good at this.
They should be really good.
It's just I'm just musing, but it just seems like I mentioned to somebody I was speaking to you and they're like, find out why Florida hospitals are not good. Like, I don't think she invests in hospitals.
Well, and I think there's just a long history, frankly, of doctors going to Florida. There's been a culture of like making money there, and the more specialists you have, the more. It's amazing. The more specialists you have, more surgeries and more things
Right.
get done, right? And so I just don't think they have the same tradition of quality that other states have had or the Northeast has had. So I can't, obviously they're good HCA hospitals in Florida, but for some reason the whole ethos there has not been the same in general.
So I'm kind of intrigued by a couple of things you've said about wanting to improve outcomes, reduce costs, and enhance experiences. And you talk about 5 levers of change that the fund looks at. And let's go through all of these. Access, outcome, cost, speed, and friction. That sounds like everybody's combined headache in healthcare.
Right.
Tell us a little bit about those 5 levers.
Well, access, I think we all learned a lot about that during COVID, right? There is differential access. And it's not just minority or city-based. Obviously, the rural environment is very challenging right
A little bit
now.
of a healthcare desert in some
It's
places.
healthcare desert. You've got pharmacies closing. You have hospitals that are an hour and a half away from people. You have challenged hospital systems. I would say in suburbia and urban environments, hospitals are actually doing quite well and making a fair amount of money. But in rural, far more challenged. So that is something that we're actually addressing in one of our companies called Main Street, which is focused on, it's a Oak Street, maybe Village MD for the rural environment, but with a different business model. And the point is for them to actually own everything in those environments except for acute care hospital and try to keep people as much as possible out of the hospital, but provide a broader set of care opportunities to those in rural environments.
So I have a vivid recollection of a television show called Northern Exposure. They wanted more doctors in Alaska, so the state of Alaska would pay for your medical school, but you had to agree to practice there for 5 years. It seems amazing that in the United States in 2024, there are healthcare deserts. Why haven't states, and I know this is not your expertise, but it seems like states should have addressed this a long time ago. How is it possible in a modern era you could be 2 hours away from an emergency room? It's unthinkable. At least in the tri-state area, it's hard to imagine.
Yeah, no, I agree. The fact that they should be incenting primary care, paying for people's medical school that will go into primary care and go to rural markets, and there are some that are doing that. I think about virtualization, though, because of one of the aspects of a Main Street or some other models we have, CareBridge, is that virtual care and wraparound care, so much of this actually can be done virtually. You can have specialists in a network that don't, your best oncologist from MSK in New York City can be advising people in rural environments, right?
Memorial Sloan Kettering.
Yes, Memorial Sloan Kettering, exactly.
So what's the difference between virtual and wraparound? How do they differ?
Well, I think wraparound may mean that you have a connectivity locally, plus you have virtual care that extends what is available locally. But wraparound could be you have, in CareBridge's case, you're managing what we call dual eligibles, which are those who have Medicaid and Medicare. They're the sickest of the sick that are in long-term services, home-based services. So they're in the home. Generally, they're sick enough to have a caregiver and who's either a family member or a caregiver who's hired to help them out. And then you're supplying, nurses and MA and others that they get to know these patients, but all virtually. But they end up, developing a relationship with the caregivers that have we have an iPad in the home with a button, essentially, like the 911 button, where you hit the button as opposed to all of a sudden for every issue sending that patient to the emergency room, which is wildly expensive, right? And not constructive because often they get admitted and then all of a sudden you have a $30,000 expense. The reality is that button is going to a nurse that's on call or in a call center for a care bridge or a Main Street that's taking care of that individual and actually knows the medical records, has developed a relationship with the caregiver and the patient, so they can walk through what are the issues. Is this a mental health crisis, which is often is, or get ahead of some of the challenges of wound that gets taken care of as opposed to in the ER, by somebody going to the home or getting them to another facility. So these are the things that it's just like longitudinal care management of individuals, and the chronically ill are those that end up in the hospital most often.
And you mentioned CareBridge. That's a company you have an investment in. It seems so obvious. How do we get better outcomes and less expensive costs by intervening before they end up in an emergency room? Again, how has this not taken place before? Is that what CareBridge's core business is?
Yes, and yes, they manage the sickest of the sick, chronically ill in the home that are dual eligibles, and that is what they do. They develop a relationship, they wrap around, but it's all about, part of this is financial alignment. They have contracts with the health plans to take care of these individuals. They get paid, basically, they have full responsibility for the cost of care for these individuals. So they're highly incented to take good care of them. Their quality.
And preempt those
emergencies, the rooms. The two most expensive things in healthcare are rising hospital costs, which are up like 20% this year, and drug costs. So if you can manage drug compliance better, and most importantly, the easiest but not easy thing to do is to keep people out of the hospital appropriately, right? Mm-hmm. Nobody wants to be in the hospital. I mean, this is the thing. Hospitals always talk about utilization management. You're keeping people out of the hospital. Well, that's actually our job, is to do preventative care and keep people from using the most expensive resource in America.
And it's always astonishing when you read, I think medical errors are the third most common cause of fatalities in the United States. That's a stunning number, and I guess why none of us really want to be in a hospital unless we
It's dangerous to be in a hospital. You don't want to be there. It is dangerous. Think about the infection rate in a hospital, right? Sort of staff, and yes, it is actually dangerous to be in a hospital. So there better be a good reason to be there. So
we talk about access, outcome. I'm kind of intrigued by the focus on cost, speed, and friction, because all three of those seem to apply to both healthcare and financial technologies.
Yes,
you mentioned they both live on old legacy systems. They're not nearly as cutting edge as they should be. Is that how you ended up being both a healthcare and a fintech investor?
Certainly between insurance and payments and rev cycle, we thought it was in 2002. And obvious place to go. And having gone into biotech early and then tech-enabled, software using, leveraging the internet in healthcare early, I just felt like payments and fintech, I wanted to be early. Like that was an area you could just tell the tailwinds were there. And so we came in 2002 before anybody knew what fintech was. And we were focused initially on the sort of prepaid, underbanked market. And
prepaid, underbanked market.
Underbanked being 60 million people in America did not have checking accounts or credit or debit cards, right? And think about what you can't do. Okay, and you had the advent of the internet. You couldn't buy things online. You couldn't reserve a hotel room. You couldn't rent a car. Like all these things that change your life. So by investing in NetSpend, which is one of the first prepaid debit cards, people could actually do those things. They could buy online. They could reserve a hotel room. They could rent a car. I mean, these are game-changing things to someone. So that was exciting because we were changing people's lives and giving them access, democratizing, credit effectively.
So it's interesting you started in fintech in 2002 because I recall former Fed Chairman Paul Volcker said only half in jest, and I want to say it was 2011, 2012. What innovation is there in the financial space other than the ATM? Nothing's happened, and it seems like that really isn't true. There's been a ton of innovation in the financial space. Tell us some of the other fintech investments you've made.
More recently, fraud. Just think about fraud as being an area of
constant battle.
Constant battle.
Arms
right?
race.
It is an arms race, and well, even more so. I mean, if you think about what happened was in the payments world, you had card present, right? You're swiping at the point of sale, and then we had the internet come along. Then you had virtualization of payments. Then fraud exploded from
right.
that. And now with Gen AI and obviously deep fakes, you have person not present. So you've got a whole different level of fraud that is being experienced right now, right? Where somebody's mimicking your voice for a call, right?
Literally just had this conversation yesterday with my head of compliance. There was I don't remember if it was Gizmodo or one of those sites that talks about the fake calls you're getting supposedly from Google, who will never really call you. Assume any phone call you're getting is a fake. But the AI agent on the other side sounds so realistic. Always ask them to sing a song, and that was the solution. An AI app will sing it until or whatever silly thing you ask. But it just seems like the ability to impersonate people is just getting better and better. Who's going to win this arms race?
Yeah. Well, I think it's just going to be a continual battle of they'll create new ways to implement fraud, and then we'll create solutions against that fraud. And so it is, I think, will be a perpetual and continual battle. We have companies like FeedZai and Prove that are focused on that area, and it could be
FeedZai focuses on risk management and combating fraud.
Combating fraud for yes, and Prove is that when you get the PIN and you're doing sort of double authentication, they're the ones that are integrated in the operating system of phones and effectively are giving you that number, that PIN when you're typing in that second number to authorize a transaction. So we have a number of companies, probably 7 or 8 in that space. Other companies that do, if you think about the America and where we are here in terms of credit payments, think about LATAM is 2 decades behind us. And so we're seeing a number of opportunities in fintech in Latin America.
2 decades behind.
Yeah, 2 decades behind, which actually will probably be an advantage, and they will leapfrog us because they don't have these.
They'll start from scratch.
They'll start from scratch and scratch. And if you look at Brazil, they've created something called Pix, which they built for $2 million, which is amazing, by their central bank. And it's real-time payments. And effectively, it's a protocol and effectively allows bank-to-bank authentication. So if you think about ACH and your cash account to somebody else's cash, it is incredibly complicated in the U.S. To do an ACH transfer, your bank account to another bank account, right? It just takes forever.
I wanted to address that. I grabbed my phone, and I'm opening the folder with the Fintech apps on it. So Venmo is the easiest thing in the world to use just to send money to someone else. But I did something in South America, in Colombia. I had an old truck rebuilt in Colombia, and I was using Remitly and WorldRemit to send, as long as it was less than $10,000 at a time. Internationally, it was like click, 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 done. Right. That was an unthinkable nightmare. I don't know, 5 years ago, 10 years ago. I'm looking at the TD and the Schwab app. I'm looking at the Chase. I mean, just the amount of things you could do on your phone. So it feels like the innovation certainly.
The innovation from the consumer experience is there. It's ironic, though, because if you think about Venmo, everything runs on the credit card rails right now,
that's
right? I mean, that's actually what's happening on the Visa rails, the MasterCard rails, or MX. And the reality is
that because that's so
expensive.
Secure? Or?
Well, it's secure and it exists, right? And it's easy. So, I mean, think about Apple, right? They run on, you're putting your credit card in for Apple Pay.
Right. Every time I take a subway, I just drop the phone on it, and that's, that goes right through the credit card.
So that's, if you think about LATAM, that's an expensive option. Right? Yeah. And so what they've done in LATAM is created a pretty friction-free Visa-like rails, but
cheaper,
very cheap, like cents, pennies, like virtually no cost. So that is probably taken like 40% credit card and debit card transactions.
Really?
Yeah.
And wasn't there a couple of things done over cell phones in parts of Africa where
Yes.
they didn't have a credit card system and just, necessity being the mother of invention, came up with some things. So my question is, are all of these various things secure? Or, what is the challenge building the next generation? What's going to replace?
I think
will anything replace credit cards?
Well, I think real-time payments will replace credit cards, but you are going to build costs on top of it, because if you're talking about large B2B payments, right, you're still going to be talking about something that and even larger B2C payments.
Right.
There is more fraud capability that needs an identity authentication capabilities that need to be built on top of it. There will be great opportunities for companies for us to invest in that will create B2B opportunities on top of PICs and on top of other infrastructures that are being built in LATAM or India or Africa.
Really, really kind of fascinating. So given these two areas that you focus on and the track record you guys have put up, I just wanted to mention again, you were named one of the top 10 venture firms of 2024 and a number of other accolades last year. How does this affect the deal flow you see in the companies you look at? Do you have your own space and that's what you drill into, or are you guys a little broader thinking about a variety of different types of companies?
We, for example, we define fintech very broadly. Like that is e-commerce infrastructure. It's fraud and identity. It is payments. It is general infrastructure. So it's fairly broad in terms of how we look at it. I think as we think about opportunity in the sector, think of us as starting things or backing an entrepreneur who has started something, because we have a whole thematic approach to an area, and I'll talk about something we just did, all the way up to a classic ABC round, right? And we'll even do an occasional buyout or two where we think there's huge growth opportunities if we invest in the tech portion of it. So something we did recently, I think is emblematic of what we're doing more lately with the $2 billion. Our most recent fund was $2 billion, and we backed the individual Dave Clark out of Amazon, who for 22 years built all the supply and logistics chain at Amazon. And he brought his chief scientific officer and a number of people from Amazon and others that he's worked with. And when we announced this company, 1,200 people that day submitted resumes.
Wow.
To them. It was extraordinary. It speaks to his reputation. And the idea is that we will build a Gen AI software, native AI software platform that will incorporate some of the supply chain software boutique best of breed software systems that are out there that constitute the supply chain. Because if you are an Amazon or someone else, you're working with 20 different vendors to complete your supply chain. And the reality is you really want that integrated in one infrastructure. And so their plan is to basically build the supply chain infrastructure.
End-to-end, one company from
software.
From when it leaves this place to it ends up that place, and all the quantitative metrics and tracking and everything that goes with it. Really interesting.
So we committed $100 million to that.
Oh, no kidding. Yeah. Oh, so that's that sounds like a pretty big bet.
Yeah, we're all in. But yes, we're doing more of the $100 million plus investments, $70 million investments, because we want concentrated bets in the areas that are most exciting to us with the best entrepreneurs.
So I only have you for another 10 or 15 minutes, and before I get to my favorite questions I ask all of my guests, I got to throw a curveball at you, which is, normally at this point in a conversation with a VC, we talk about you've had 70 exits and 15 IPOs, but you're also the First Lady of Connecticut. You're married to Ned Lamont, the governor of Connecticut. Kind of an unusual role for First Ladies, being a VC. Tell us how you juggle these two roles. You're the first VC I've spoken to who's also in a state house.
Right. It is unusual. The great news is that there is no expectation for the First Lady of Connecticut. Like there is no established role. And so I'm really just a partner to my husband, as I would be in terms of just their support and guidance. But I do campaign with him. I go on on weekends. We do things together. But he's very much running the state of Connecticut while I am doing my thing, during the week. And then we come together in Connecticut and Greenwich during the weekend. But it's fascinating. He loves the job. I'm biased, but I think he's done a great job for Connecticut as a businessman himself, but somebody who has a social conscience. So it's been fun to watch because he does love the job.
Really, really interesting. All right, let's jump to our favorite questions that we ask all our guests, starting with, since you mentioned you like to spend the weekends with your husband, the governor. What do you guys do on the weekends? What are you watching, listening? What's keeping you entertained?
All right, let's keep it UConn basketball. I can't wait to have it back. So women and men are going to be amazing this year. So and they have been. Obviously, the men have won 2 years in a row.
Huskies have a great team. They've been winning for a long time.
Amazing.
And the women's team has done really well also the past few years.
Gino is incredible. I mean, the fact that they had 5 injured players and got into basically the Final Four was incredible. So between Gino Auriemma and Dan Hurley, 2 of the best coaches in the country. So that's been super fun. We go to games and we watch on weekends. But we're I don't know if I'm an athlete, but I love sports. And we love sports. We play golf and tennis and hike, and it's being out ski and being outside as much as possible. And he watches, and he's been a long-suffering Jets fan. We're hoping the Jets are back, and I happen to be a Packers fan, being from Wisconsin, so we compete.
Really interesting. Tell us about your early mentors who helped shape your career.
Yeah, there was an individual, Jerry Gallagher. I'm from Wisconsin. He was from Minnesota, and he ran for a prior firm. He ran the retail investing. And was a brilliant investor. I mean, he was somebody at Donaldson, Luff, and Jenrette in the early days. He was the retail analyst, and he actually invented the same-store sales metric.
Oh, no kidding.
If you can imagine, people were just saying, oh, that company's growing 100% a year. They didn't know if they'd added 100 stores, double the number of stores. But so he actually invented that. He joined us and invested in, it was a Filene's basement. Whole Foods, Amazon, Whole Foods, which we sold to Amazon, Dick's Sporting Goods, Office Depot. It was just P.F. Chang, Jamba Juice. I mean, just an unbelievable track record, the best retail investor in the country. And he taught me a ton. So he was the first person when I was 27 years of age who said to me, you're focused on the idea, you're not focused on the CEO enough. You're not focused on the people. Like, you have got to raise your bar on CEOs, and of course it's I mean, it's so obvious. It's all about the people, but I think you do get enamored with trends, secular trends, and ideas, and ultimately it was the most important advice anybody ever gave me, because it's all about the CEO at the end of the day and the team they can attract and how they treat people. And I think it was very much golden rule. Some might have considered Jerry old-fashioned, but the reality is that old-fashioned message just cycles back in every crazy cycle we have with entrepreneurs, and that is, just obviously do the right thing, and treat people like you'd like to be treated, and be kind, and yet, be direct and be tough.
I don't remember which VC it was that said the same thing that you just said about backing the team and the entrepreneur, not the idea, but to drive the point home, hey, each of these companies that have had a successful exit, they've pivoted 5 times, and however it works out, it's never the initial idea. It's always the person. And I never really thought about that until
100%.
Right? It's if you're betting on the idea, you're 3 iterations away from where it's going to end up.
Right. Yeah, and the general idea and secular trend may be right, but actually the business model is wrong. So getting the business model is so critical.
Really, really interesting. Let's talk about books. What are some of your favorites? What are you reading right now?
Well, original favorite was To Kill a Mockingbird, and I would say that influenced my sense of social justice. And then it's probably the Robert Massey books. And, I've never been to Russia, but I've been fascinated by, Peter the Great, Nicholas and Alexandra, Catherine the Great. I mean, it's so, if you look at what's going on in Russia now, same exact, like you understand cultures, right? I mean, it's sort of like understanding history and culture. It doesn't change that much, right? I mean, that is a country that understands suffering and likes autocrats, basically.
And
they like strong leaders.
Not a coincidence, right?
Yeah, not a coincidence. So, yeah, and then most recently, The Money Trap, written by a friend of mine, Alok Soma, is a fascinating book. He was the head of SoftBank during the crazy period in North America. Yeah, and he actually had never written a book. He went to the creative writing program, got his visa, and was able to stay in America. Went to the creative writing program in New York City and wrote this book. And it's absolutely beautifully written, and it's fascinating. So I highly recommend it. Money Trap.
I'm gonna put that on my list.
Yeah.
If you're, you mentioned books about Russia, and I know you're talking more historically. If you haven't read Red Notice by Bill Browder.
I know Bill, and yes, I read it. Yeah,
astonishing.
Unbelievable. Yeah.
It reads like it's fiction, and it's such a page turner. Yeah. All right, our final two questions. What sort of advice would you give a recent college grad interested in a career in either venture investing, healthcare, fintech? How would you advise them?
They have to go work inside companies, and they should go work in a startup, in an early stage company, and maybe mid-stage, and definitely a larger legacy company, because they need to understand business. I mean, when I read the New York Times business section now, I think these people have never been in business. And obviously Bloomberg specializes in it, and so has a lot of reporters that deeply understand it and respect it. But I think that you can't write about something you haven't actually lived at all and truly understand what is. There are obviously things that are very flawed in business, and it's often, particularly in the early stage, extremely chaotic. But it is what drives our economy, which provides jobs for people and employs people and allows them to pay their bills and support all our great social programs. So it's important to understand.
And our final question, what do you know about the world of investing today you wish you knew back in the 1980s when you were first getting started?
It's an interesting question because and maybe because I have a Teflon memory, but I feel like I only remember the good things. I think, knowing that large secular changes are the most important thing that drive investment waves and ultimately build great companies. Just focusing on those, but I feel like I ended up actually doing that well. Picking the secular wave that made sense and getting ahead of it, but not too far ahead of it.
I was going to say you did that well, but you were also early in a lot of big secular trends.
Yeah, so I would say that ended up working out well. You can't be being too early is a killer, right in investing. So that worked out well. But I would say, in general, don't sweat the small stuff. Get the large things right, and the rest of it will take care of itself. So I would only caution those that are starting out now in the investing world, or frankly in any career, to just all those things that seem so important that are so small during the day. Just remember that, think about yourself 40 years from now. What's going to matter? What will have mattered to you? What will have mattered to your success? And just focus on those things, and don't focus on all of the petty, small things that may gone wrong or the people around you. And then otherwise just stay away from toxic people and make sure you carefully work with people you love and respect. And I think in general I've done that, but I think there are times where I would have walked away. I would have started Oak HCFT so much sooner. That would be the one change in my career that I would have made.
Really interesting. Thank you, Annie, for being so generous with your time. We have been speaking with Annie Lamont, co-founder and managing partner at Oak HCFT. If you enjoy this conversation, well, be sure and look up any of the previous 500 discussions we've had over the past 10 plus years. You can find those at Bloomberg, iTunes, Spotify, YouTube, wherever you find your favorite podcasts. And be sure and check out my new short-form podcast, At the Money, conversations with experts about your money, earning it, spending it, and most importantly, investing it. At the Money in the Masters in Business feed or wherever you find your favorite podcasts. I would be remiss if I did not thank the crack team that helps me put these conversations together each week. Anna Luke is my producer. Sean Russo is my head of research. Steve Gonzalez is my audio engineer. Sage Bauman is the head of all podcasts at Bloomberg. I'm Barry Ritholtz. You've been listening to Masters in Business on Bloomberg Radio.